Investing is simple but not easy. Warren Buffett. When it comes to securing your financial future, there's a straightforward path: buy and hold forever. We've seen that done before with dividend stocks, but can the same or even better results be achieved with dividend ETFs? John, with $15,000, wants to know the answer to this exact same question. So, in this video, we will show you 6 buy and hold forever dividend ETFs. We'll show you how much John can earn in dividends and capital appreciation from an initial investment of only $15,000 in 10 years, 20 years, and 30 years from now. In the end, we'll show you an ETF that adds over $700,000 to John's portfolio and pays over $70,000 in annual dividends. Here are the top 6 dividend ETFs arranged from modest to the highest dividend per month over 30 years. Starting off the list at number 6, we have Vanguard S&P Mid-Cap 400 Growth Index Fund ETF shares. Known by the ticker symbol IVOG, this fund tracks the performance of the S&P Mid-Cap 400 Growth Index, meaning the mid-sized companies with strong growth potential. The ETF has a current dividend yield of 1.14%, backed by a strong dividend growth of 14.02%. It also backs a strong average annual share price growth of 8.01% every year. Based on these metrics, if John invests $15,000 in this stock, after 1 year his investment will grow to $16,373. In 10 years, it'll be valued at $37,218. Give it another 10 years, and after 20 years, it'll be valued at $102,891, paying an annual dividend of $3,190. Fast forward to 30 years, and John's initial investment, after 30 years, will be valued at $344,281, paying him an annual dividend of $18,672 or $1,556 per month. In total, after 30 years, this ETF will have added $329,281 to his portfolio, with $214,555 from capital appreciation and $114,725 in total dividends. This means this ETF is not just a dividend ETF, it's also a growth ETF. It invests in sectors and companies that have a bright future, like Steel Dynamics, Carlyle, and Axon. These companies have proven their ability to grow their sales and earnings even in challenging economic conditions. This ETF is also a smart choice for risk-conscious investors if you look at the beta, which shows how risky the stock price is. This ETF has a beta of 1.09, which means it's slightly more volatile than the market, but not too much. And with 236 holdings, it diversifies your portfolio and reduces your exposure to single stock risk. And the best part is, IVOG recently underwent a 2-to-1 share split, which means you can buy its shares at a lower price. Now, when it comes to dividend ETFs, the bond sector cannot be ignored. Therefore, the next one on our list is the iShares Select Dividend ETF. Known by the ticker symbol DVY, this ETF has an impressive average annual yield of 5.25%, which is much higher than the S&P 500's yield last year. It also has a dividend yield of 3.82%, backed by a dividend growth rate of 7.43%. With these metrics in mind, an investment of $15,000 by John in this stock is estimated to grow to $16,361 after 1 year. After 10 years, it's projected to be valued at $37,062. Given 10 more years, and in 20 years, it'll be worth $100,424, paying an annual dividend of $5,206. Moving forward to the 30-year mark, John's initial investment will be valued at $304,765, offering an annual dividend of $19,360 or $1,613 per month. Over the span of 30 years, this ETF will add $289,675, with $134,005 attributed to capital appreciation and $155,760 in total dividends. Though the end portfolio is lower than our last ETF, the dividend growth is faster in this ETF as it's more dividend-focused. This ETF is a smart way to invest in high-quality U.S. companies that have a history of paying dividends. It tracks an index that selects stocks based on dividend growth, dividend consistency, and dividend coverage. Matter of fact, these holdings are selected based on a history of consistently paying dividends. What sets this ETF apart is its methodology of selecting stocks with above-average dividend yields. It also focuses on the large cap value segment of the market, which tends to outperform growth stocks over the long term. To top it off, it offers diversification as it includes a mix of companies from various sectors. This diversification reduces risk, making it an attractive option for risk-conscious investors. So, investing in DVY is a wise move. And speaking of wisdom, the next one has wisdom in its name. The Wisdom Tree U.S. High Dividend Fund ETF, with the ticker symbol DHS. With an average dividend yield of only 3.94%, this ETF is more focused towards its dividend payments, which can be seen from its current dividend yield of 4.26% and a dividend growth rate of 7.14%. This ETF, compared to other dividend ETFs, also offers a competitive edge in terms of yield and cost. Based on these metrics, a $15,000 investment by John in this stock is projected to grow to $16,230 after 1 year. Over 10 years, it's estimated to be valued at $35,083. Fast forward to the 20-year mark, and it should be worth $96,884, paying an annual dividend of $6,723. Looking ahead to the 30-year point, John's initial investment is projected to reach $334,484, generating an annual dividend of $31,007 or $2,584 per month. Over a 30-year period, this ETF is expected to contribute $319,484 to John's portfolio, which will include $100,637 in capital appreciation and $218,847 in total dividends. If you think this value addition is good, wait till the last ETF, which adds over $700,000 to John's portfolio with even better dividends. One of the key strengths of the DHS ETF lies in its holdings. It tracks an index composed of high dividend yielding U.S. stocks, emphasizing companies with strong dividend fundamentals. These holdings typically include well-established firms with a history of consistent dividend payments, offering investors a reliable income stream. The fund invests in a diversified portfolio of about 392 large-cap value stocks. But what sets this ETF apart is its dividend-weighted methodology. Unlike traditional market cap-weighted ETFs, it assigns more weight to companies with higher dividend yields. This approach can lead to a portfolio that focuses on income generation, potentially delivering higher yields compared to other dividend ETFs. Next, at number 3, we have First Trust Morningstar Dividend Leaders Index Fund ETF with the ticker symbol FDL. Like others, this one tracks an index of U.S. companies with consistent and sustained dividend payments, but it excludes real estate investment trusts, which normally have high payouts but low growth potential. This fund has an average annual yield of 5.09%, a good starting dividend yield of 3.8%, and a dividend growth rate of 9.15%. Based on these metrics, if John invests $15,000 in this stock, his investment is expected to appreciate to $16,334 after 1 year. Over the course of 10 years, it's projected to reach $37,733. Extending the timeline to 20 years, the value is estimated to be $116,137, providing an annual dividend of $8,305. Fast forward to 30 years, and John's initial investment is set to be valued at $479,113, with an annual dividend of $49,288, equivalent to $4,107 per month. In total, after 30 years, this ETF is expected to add $464,113 to John's portfolio, with $162,412 coming from capital appreciation and $301,700 from total dividends. One of the standout characteristics of this ETF is its holdings. It tracks the Morningstar Dividend Leaders Index, which comprises high-quality dividend-paying companies with a history of consistently strong dividend performance. What sets this ETF apart is its smart beta approach to selecting and weighting stocks. It selects and weights its holdings based on their dividend history and sustainability, ensuring that it invests in quality companies that can maintain or increase their dividends over time. This strategy allows FDL to capture the benefits of dividend investing, such as lower volatility, higher returns, and tax efficiency. Now we move on to a dividend ETF that pays over $5,000 per month over the long run. At number 2, we have Schwab U.S. Dividend Equity ETF with the ticker symbol SCHD. This fund has an average annual return of 7.62% over the past 10 years, a dividend yield of 3.5%, and is backed by a strong dividend growth rate of 11.39%, which means it's both a dividend and capital appreciation-focused ETF, a win-win for long-term investment. These metrics make it a better option than other dividend ETFs, which may have lower returns, higher fees, or less stable dividends. Considering these metrics, a $15,000 investment by John in this stock is expected to grow to $16,668 after 1 year. Over 10 years, it'll be valued at $45,667. Extending the time frame to 20 years, the projected value is $163,994, with an annual dividend of $10,110. Looking forward to the 30-year mark, John's potential investment will be worth $744,396, generating an annual dividend of $64,655 or $5,388 per month. In total, over 30 years, this ETF is projected to contribute $729,396 to his portfolio, consisting of $349,049 in capital appreciation and $380,346 in total dividends. One of this ETF's primary strengths lies in its holdings. SCHD tracks an index that includes U.S. stocks with a consistent history of paying dividends, the Dow Jones U.S. Dividend 100 Index, which selects 100 high-quality stocks that have paid dividends for at least 10 consecutive years. These stocks are industry leaders like PepsiCo and Pfizer, which have strong fundamentals and competitive advantages. The ETF also diversifies its portfolio by capping each stock's weight at 4% and each sector's weight at 25%. This reduces the risk of concentration and turnover and improves the fund's performance and efficiency, in turn offering a reliable source of income, a potential for growth, and a low-cost exposure to the quality factor. Lastly, topping our list at number 1, we have Invesco High Yield Equity Dividend Achievers ETF. Known by the ticker symbol PEY, this ETF has an average annual yield of 6.39%, a dividend yield of 4.58%, and a dividend growth rate of 9.57%, a more balanced approach towards both capital appreciation and dividend growth. Before showing how much John can earn from this ETF, first let's see why this ETF makes it to the top of the list. This ETF also invests in stocks of U.S. companies that have increased their dividends for at least 10 consecutive years. So it focuses on companies that have a strong and reliable history of dividend growth, which is a sign of financial health and shareholder value. However, this ETF has a dual focus on yield and growth. While it targets high-yielding stocks, it also emphasizes companies with a history of dividend growth. This strategy aims to provide investors with a robust income stream while positioning them for potential future dividend increases. This reduces the risk of concentration and enhances the exposure to different sources of dividend income. This can be seen from its low beta of 0.86, which means that it is less volatile than the market and can offer some stability in uncertain times. Back to how much John can earn from this ETF. Based on these ETF metrics, if John invests $15,000 in this stock, after 1 year, his investment will grow to $16,646. In 10 years, it'll be valued at $45,287. Give it another 10 years, and after 20 years, it'll be valued at $162,494, paying an annual dividend of $11,762. Fast forward to 30 years, and John's initial investment after 30 years will be valued at $734,850, paying him an annual dividend of $70,859 or $5,905 per month. In total, after 30 years, this ETF will have added $719,850 to John's portfolio, with $289,834 from capital appreciation and $430,016 in total dividends. These buy and hold forever ETFs sound good, but maybe you want to become a millionaire or perhaps a multimillionaire one day. For this, watch our video on the 7 best index funds that'll make you a future millionaire.